You've owned your home for years and you've heard rates have gone up, rates have gone down. But if I were to ask you to explain it, you'd be unable to do so. And it's not your fault. Nobody explains this. I work inside one of Canada's largest lenders, and now as a mortgage broker, I've had this conversation happen hundreds of times every month. And I'll tell you this, that people will decide on a rate at renewal, not understanding the underlying numbers that have affected what's in front of them. In this video, I'm first going to explain why rates feel random. I'm also going to explain the underlying numbers that affect these rates, and then how all of this ties together. And here's the thing that most people don't understand, that banks don't actually set your rates. Most people think that a bank has a meeting every morning to decide what rates they're offering you. And that's just not the case. Actually, what's happening is that the bank is reacting to this underlying number. So what's actually causing these rates to move? And before we get into this, we need to understand government debt. And please, just stay with me. I promise all of this is connected. Okay? So as you know, the government spends money. If the government spends more than they make, they have a deficit. Okay. And a deficit just means that the government has debt. When that happens, they need someone to pay the difference. Okay. So they sell their debt. All this means is they're trying to get someone to loan them money, just like a mortgage, but on a much larger scale. Okay. So how do they do that? They do this by issuing what's called a government bond. It seems way more complicated than what it is. Think about it this way. It's just an IOU from the government. Okay. So they say, give me $1,000 in 5 years. I'll give you the $1,000 plus some interest. The interest in this case, people call yield. Okay. So the bond yield is just the interest rate that the government has to pay on their debt. So what affects this interest rate? Well, just like everything, it depends on how many people are willing to pay or offer to pay for your debt. Okay, when there's high demand, where there's lots of people offering to lend you money, the interest rate is going to be less. So think about it this way. If you're Taylor Swift, you're a billionaire, okay? And you ask for $1,000, people are going to give it to you because there's a high likelihood that you're going to pay it back. And a lot of people are willing to lend to her. Now, on the other end of the spectrum, you've declared bankruptcy 4 times, okay? You have one person who's willing to lend you money. Are you going to have to pay higher interest or lower interest than Taylor Swift? In most cases, it's going to be higher interest because that one person can charge whatever they want. There's no competition. Government debt is the same way. I know what you're thinking. You say, Jeff, okay, fine, I get that. But how does this tie to interest rates? Well, let me explain this to you in the easiest way that I can. Investors view government debt as risk-free. The chances of a government defaulting on the loan is 0. And again, people can argue whether that's the case or not, but investors view that as fact. When you're being lent money for a mortgage, you have to look at what people can make with no risk. Okay, so people will often ask me when people hear, oh, look, fixed rates or rates in general are tied to the bond market. Well, if the bond rate is 3%, why am I not getting a 5-year fixed rate at 3%? Well, we need to entice people to invest in mortgages rather than government debt. Okay? And because the chances of you not paying your mortgage are higher than the government not paying their debt, you need to pay a little more. That is what we call a risk premium. Okay, risk premium just meaning the extra money we need to pay to entice people to lend you money. So this is the important part. The risk premium changes depending on how likely it is that people stop paying their mortgage debt. So when the economy is doing super well, okay, the chances of you not paying your mortgage are less. When housing prices are increasing, unemployment is low. All of these things make it less likely that someone is not going to pay their mortgage. Okay. On the other side, if everyone's talking about a recession, if unemployment is high and the chances of housing prices going down, there needs to be a much larger incentive to invest in mortgages. So in Canada, typically the range for this risk premium is 0.5 to 1.2%, somewhere in that range. So before we get too far into this, let me give you 2 examples. Okay, so in April of 2021, the 5-year Canada bond yield was about 1%. Fixed rates at the time were in and around 1.49%. Okay, so That gives us a risk premium of 0.5%. Why is that? Well, the economy was humming, unemployment was low, people were getting extra cash. So the likeliness that people were going to default on their mortgages was extremely low. Now let's look at April of 2026. Bond yields are at 3%. Fixed rates are around 4.5%. That's a risk premium of 1.5%. So why is that? Well, first and foremost, everyone was talking about a recession. There's factors in place that can cause things to become more expensive. And when things become more expensive, people are more likely to default on their mortgage. So this is an extreme case in April 2026 of a risk premium being applied. So I like to think of this as the fixed rate change. So the first thing that we need to look at is government debt. Okay, what is the interest that the government is charging? You can look this up pretty simply by searching 5-year government bond, 5-year government debt yield, 5-year government debt interest rate, but interest rate is not often used. They use yield mainly just to make things a little bit more complicated for you. Okay. Then we need to look at the risk premium and just ask yourself this question. How likely is it for someone to feel like people are not going to pay their mortgage? The more you hear about recession, the more you hear about housing crashes, the more you hear about unemployment going up, the more likely you're going to be at the higher end of this risk premium. If the economy's humming along, again, that's going to be closer to that 0.5% risk premium. So this is kind of how you can determine in advance what rates are going to be. Now, we've talked about fixed rates. Does this apply to variable rates? Do bonds affect this? No. And let me explain this to you as simply as I've done for fixed rates. And look, this first part, most people have heard, look, the Bank of Canada has increased rates. Bank of Canada has lowered rates. And they made the assumption that the Bank of Canada is what controls rates in general. And in actuality, the Bank of Canada isn't changing any rate attached to mortgages. So what does the Bank of Canada actually control? Okay. Think about it like this. Banks will lend money and they have to have money set aside to honor this. So what does the Bank of Canada actually control? Well, banks will lend people money. And in some cases, at the end of the day, they may have lent too much money. They have to borrow money from someone else. So think about it like this. You gone out for dinner or gone to the bar and you have to borrow money from somebody for a cab ride home. Well, banks are greedy. And I don't know if you've ever had a friend like that, but the Bank of Canada steps in to control how much they can charge each other for lending money for the night. It's called the overnight lending rate. So you may be asking, okay, then why, when the Bank of Canada meets and they change rates, does my variable rate change? Well, the answer is pretty simple, and it's something called a prime rate. Okay. And the prime rate is the goal, what the banks are hoping to make on their money. So right now, the overnight lending rate is at 2.25%. So think about it like this. If the banks were to lend money and have to borrow from another bank, they would have to pay 2.25% for that money. The banks want to make a set amount above that to make it worthwhile for them to lend out that money. So today that spread is 2.2%. So 2.25 is the overnight lending rate. The prime rate is at 4.45%. And so we said that was the goal, but banks often undercut each other for your business. So for mortgages, it is very common to get prime minus a number. Okay, so we can see as low as prime minus 1.25% on a mortgage. On the other side, let's say a line of credit, okay, tied to your house, the rate is somewhere between prime and prime plus a half. If we look at even riskier lending products like an unsecured line of credit or a credit card, you're going to see prime plus 10, prime plus 15, prime plus 20. And in that case, again, it's a risk premium applied to your rate or to the prime rate. So now you understand how fixed and variable rates actually are made. Okay, so that's the start. But how do you actually use this at renewal? And there's two main mistakes that people make. They either react to headlines, they see what other people are saying in the market and make a decision without understanding the underlying information. The other side, you just bury your head in the sand and just sign what's in front of you. So what should you do for this to actually help you? And look, the goal is not to predict perfectly. The goal is to understand, okay, what is the bond yield doing? Okay, what is the direction of these yields? Okay, what is the risk premium? How likely is it for someone to default? Once you understand that, you can get a good base of what you should expect on interest rates. Okay, and that's just the start. The next thing that you need to do is learn how to negotiate, because like I said before, banks will undercut each other and it's important to know how to negotiate. Again, we'll talk about that at the end. So the choice between a fixed and a variable rate becomes a bet, or the chance of where this is going to change over the short term. So again, all things being equal, the choice between whether you choose a fixed or a variable interest rate is based off of where you think that these risk premiums and interest rates are going to go. And what felt like guessing before becomes pattern recognition. Your confusion came from seeing the results without understanding the underlying metrics. And look, now you understand the system. So the government borrows money. The bank has to charge a risk premium for someone to invest in your mortgage versus the government debt. And that ranges depending on how well the economy is doing. On the variable interest rate, the Bank of Canada sets the overnight lending rate. That's the rate that banks charge each other. Banks want to make 2.2% above that for lending out the money. Then they discount in case of most mortgages or add a risk premium depending on what's going on in the economy and how desperate they are for that business. And so next renewal meeting, you'll know what to expect. But what you're missing is how to actually negotiate with a bank and a broker together so that you get the best interest rate. I made a video telling you exactly step by step what you should be doing to get the best interest rate for you. If you're within 12 months of your renewal, this is the most important video that you'll watch.